For today's session, we're going to talk about really two things. One, we're going to go over homework 3 just to make sure that everybody understands how to do it so that will set up homework 4. So in our Canvas course site, if you go to Files, you will see under the Homework 3 tab the Homework 3 solution. So what we're going to do is we're going to recreate the solution just to make sure everybody completely understands how to do this conversion. Then, remember there's no class on Wednesday. In lieu of Wednesday's class, you will need to complete homework 4. So homework 4 is similar to homework 3. There's the file. If I open up my Excel file for homework 4, then primarily what's going to be different between homework 3 and homework 4 is homework 4 is going to have many new categories. So a far more complicated income statement and a far more complicated balance sheet, all right, with new categories. But again, everything is labeled. Okay? So just as you converted homework 3, you'll need to convert as individual assignment the new homework 4. It'll be due a week from today, Monday. Since I'm giving you class time on Wednesday, there will be no extensions unless it's a truly exogenous circumstance. So again, if you call me on Wednesday or Sunday and you say my computer died on Sunday night, I can't complete it by Monday, it's not going to be grounds for an extension because I'm giving you class time to work on this on Wednesday. Right? So use that to your advantage. Right? Now, this is worth 3 points. The other difference between homework 3 and 4 is in homework 4, you're also going to have to do an essay write-up of a CFI analysis. So we're going to go through that in the second half of the class today, but that's the other part that's going to be new to homework 4. And again, it's very similar to the midterm exam, which is going to be 2 weeks from today. All right, so coming up on the midterm very quickly, you're going to have to do this in an hour and 15 minutes, right, for part A of the midterm. And the midterm is going to be like this, just more new categories and probably more years. And by the way, just pay attention at the bottom that I change, for example, the cost of capital, and I left the tax rate the same for this one, but I will be changing the cost of capital and tax rate consistently across these assignments. So don't just hard-code in numbers from previous assignments. All right, so as I said, what I want to do today is go back to homework 3 and this is the homework. For today's class. And I just want to do sort of a quick conversion in class just so that, again, we all make sure that we understand the process. As I mentioned, I had already put up the solution to homework 3. Right? So what I recommended was creating new tabs. So we should have a new tab for TFI, a new tab for TII, and eventually a new tab for CFI for our homework 3 assignment. Again, it doesn't matter whether we start with TFI or TII first. I'm going to start with TFI, balance sheet. And again, I'm going to copy and paste over the years. So I want to start out with my TFI, so I'm rearranging everything that's operating together onto this statement to create what we're going to call invested capital. Right? So in this case, I look for anything that's labeled a 1, and on homework 4 and on the midterm, I'm going to continue to label these. Now, once we pass the midterm and you're dealing with real company financial statements, you're not going to see labels. You're going to have to figure them out for yourselves. But at least now, I'll give you the labels. So again, on the balance sheet, anything that's labeled as a 1, and again, I'll start out with the idea of doing operating working capital, so a current 1, operating cash, receivables, inventory, and payables. and that will get me what we'll call operating working capital, and I'll call it operating working capital to distinguish from what the accountants would call working capital. Good example on this assignment. If you just use the traditional definition of working capital that you learn in accounting, which is current assets minus current liabilities, you would not get a correct answer because you wouldn't have taken out excess cash, you would have left in short-term debt, and you would have left a 2 or 3 with your ones, and you wouldn't have the right operating working capital. So again, make sure you follow the process that we're defining in this class. So again, all of my short-term ones, operating cash plus receivables plus inventory minus payables gets me my working capital. And I'm going to add that to my long-term ones. In this case, my long-term ones would be net PP&E and goodwill and intangibles. Now, if I had any long-term liability ones, I would have to net those. So just as I added in the assets and subtracted out the liabilities to calculate working capital, if I have a liability one that's longer term, I would have to net that out as well. And that will be the case on your next assignment. Okay, so in this case, I'm going to sum these up, and that's going to get me my invested capital. So invested capital would be the working capital plus the long term, and it would be those 3 numbers. Now, I want to then add in anything that's non-operating. So anything that's a 2, in this case excess cash, anything else that's a 2, equity investments, and as I said, if I had any non-operating liabilities, I would subtract those out just as I added in the non-operating assets. Again, in this assignment, I didn't have any. On your next assignment, you will have non-operating assets. So make sure you net those out. Sorry, non-operating liabilities. Make sure you net those out against the non-operating assets to get a net investment in the non-operating activities. All right. So when I add together my 1s and my 2s, I should get my TFI, total funds invested. And that is going to be financed long-term by debt and equity. So anything that's interest-bearing debt labeled a 3, in this case short-term debt, long-term debt, and all the way down to treasury stock. And if I sum my 3s and 4s, then I should match my TFIs. Okay, so that gets me my balancing statement of total funds available to investment. Okay. So what do I know? I know at this point that I have, for example, in 2012, 3667 of invested capital, 4105 of total TFI when I put in my non-operating investments, and that is funded long-term by 4105 of debt and equity. Okay. All right, that's the first statement. My second statement will be to do the same rearrangement using our process with the income statement. So again, I'll change my zoom. It's a little bit easier to see. Again, copy and paste relative so I can copy and paste the years. Make sure I use the same columns in the new sheet. And I'll start out with anything that's a 1. On the income statement, my 1 said the shortcut that we could use is EBIT or operating income. I would then have my tax on my EBIT, and that would get me my no plat. So my EBIT's tax rate is 30%. Again, that's going to change by assignment and by company, so make sure you constantly check what the tax rate is. And then equals EBIT minus the taxes on EBIT would give me my no plats. Right. And then what I'm going to do is I'm going to look, that's my 1s, impacts of the rearranged income statement. I'm going to look for anything equals a 2. in this case, non-operating income. Now, I know that this is a pre-tax number. Two reasons. One, I know the category, but two, I also notice on the income statement, it's above income taxes. So generally on income statements, things above income tax are pre-tax. Things below income tax are after tax. So therefore, anything before I pay my income taxes, profit before tax, is going to be a pre-tax number. So therefore, what I'm going to have to do is I'm going to have to tax affect this. So my tax on non-operating income, get it a 30% tax rate, would get me my after-tax non-operating income. So my non-operating income minus the taxes, copy and paste that out for the 3 years. Right? And then my total income available to investors is my no plat, my ones plus my twos, my after-tax non-operating incomes, and that would be the total income available to investors for the 3 years. Right? Now you'll notice that we then have to do our 3s and 4s. Right? So I look at anything that's labeled a 3 on my income statement. In this case, it's my interest expense. Again, that is a pre-tax number. So I have to tax affect the interest. So I need a tax shield. That's going to be 30%. Now, one of the things is that on this side of the statement, financing side, payments are positive numbers, and this is going to be a payment to the interest expense to the debt holders. So therefore, the sign can't be negative, it would have to be a positive, so I've got to flip that sign. And that would get me my after-tax interest expense after I take out the tax shield. Interest expense pre-tax minus tax shield is my after-tax interest expense. And I'm going to add to that any 4s. My 4s would be my net income. Now you'll notice on the data tab that dividends was listed as a 4, but it's not technically part of the statement of TII because the statement of TII stops with net income or net profit. Right? I put dividends on the data tab because we need a cash flow available to investors, dividends to represent the equity cash flows. And that's something you would have gotten off the cash flow statement, and I didn't give you a GAAP cash flow statement. So we don't actually put dividends on the statement of TII. Right? So if you try and put it on there, the statement's not going to balance. Right? So in this case, I stop with net income. I add my 3s and 4s together, after-tax interest expense plus net income, and hopefully, if I did everything right, that my TII is balanced. Right? And that would be a correct solution. Now, I'm assuming that as you were doing this homework, that these two statements you probably didn't have a lot of problems with and probably got these relatively quickly. Right? The next statement, the cash flow available to investors, is probably the one that caused a little bit more challenge. All right? So now that we've gotten these two statements converted, we're going to do our CFI. So again, relative years, so I can copy and paste. All right, so when we do CFI, remember it's the impact of cash from the income statement minus the change in the balance sheet. All right, we're going to do that for each one of those areas, for operating, for non-operating, for debt, and equity equivalents. Okay, so I'm going to start out. Excuse me. I'm going to start out and do the operating items. So, start out with my TII. I'm going to start out with my no plat to get my income statement impact. And I'm going to add to that to get my gross cash flow depreciation. Now, in the income statement, depreciation is listed as a negative number. Since I'm going to add it, I have to do a double negative, or in this case, flip my sign to make depreciation a positive number on this statement, because gross cash flow is no plat plus depreciation. So equals my no plat plus depreciation, and that's my gross cash flow. Right? And from that, I subtract out my gross investment. Now I'm going to do gross investment first in the granular method. And as I said, we can do a couple of shortcuts here. One is I'll shortcut working capital. So change in the balance sheet, change anything that's operating, change in the ones. So it'll be my change in working capital equals, from the TFI, working capital went down by 123, and then it went up by 137. Next, I'm going to do my change in net PP&E, which is driven by my capital expenditures. So in this case, equals, from the TFI, net PP&E current year minus previous year plus CapEx would include current year's depreciation. And then I have to do a change in goodwill and intangibles equals, from TFI, current year minus previous year, so that my gross investment is the sum of those. Now, if I had any long-term operating liabilities, I would have netted those out, which would have reduced my gross investment. Okay, so make sure you include those when you do your next assignment, because homework 4 will include some long-term operating liabilities, which would be netted out. And then that will get me my free cash flow equals gross cash flow minus gross investment. Right. And as I said, we can also verify this by using our shortcut for gross investment, which was change in invested capital plus depreciation. So invested capital this year minus previous year plus current year's depreciation would have been the shortcut, which gives me the same number as if I did it granularly. Okay? So that is my free cash flow. That is how much cash I generate from operating activities after reinvestment back into the business. Okay? That's the impact of what we'll call our ones. Now I have to add in the non-operating cash flow impacts, just as I did the operating. Again, I'm going to start with the income statement. So anything that's non-operating on the income statement, TII. In this case, I got to look at the tax-affected numbers, so my after-tax non-operating income. By the way, I forgot to keep my ones on there. And then I have to look at the change in the balance sheet, change in non-operating investments in the balance sheet. So in this case, it'll be a change in excess cash, and it'll be a change in goodwill and intangibles. Those are my twos on the TFI. So again, excess cash went up from 230 to 249, change of 19. Goodwill went from 50 to 300. All right. And then when I add all those up, I'm eventually going to get something called CFI, cash flow available to investors. Now I do have to think about signs. And as I keep repeating, for signs, the only answer is to think about the impact of the cash flow on each of these items. That is the best way. So cash flow available to investors represents the total cash that this company, if positive, can pay out to investors. If negative is the amount that the long-term investors, debt and equity, would have to put into the business. Right? So what I have to understand is each of the items contributing to what I can pay out, or is it causing shortfalls of what I would have to raise? So free cash flow, positive, adds to my CFI. After-tax non-operating income should add to my CFI, gives me more income to pay out. Increase in excess cash. All right, if I take money out of my checking account and I send it over to savings, that decreases the amount of money that I have available to pay to my investors. Okay? So in this case, an increase in excess cash is going to reduce, so I got to flip the sign, my cash flow available to investors. Same thing. If I go buy another company for $250, that reduces the cash that I have available to pay out to investors. So an increase in goodwill will reduce my CFI. I got to flip the sign. So if I want to sum all these up, free cash flow plus non-operating cash flows, that will get me my CFI, which is 179.4 negative and negative 304. Yeah. Well, the difference is that goodwill is considered operating and equity investments is considered non-operating. So goodwill occurs when I buy another company that I'm going to run. And so therefore, the difference between the price I pay and the assets I acquire, their net asset value, shows up as something I have to record called goodwill. All right? But the point of goodwill is I'm buying assets that I'm going to actually run to sell more products based on the assets I acquire. If I make an equity investment, I use cash, but I'm not going to run that business. I'm just going to take a minority stake and I'm going to let somebody else run that business. So they're both uses of cash, but one is operating and the other is non-operating. So they go into each of the areas accordingly. Right? Now, what I know here is that my CFI is negative in both years, for 2011 and 2012, which means I need to go get cash. That the business in and of itself does not have enough cash to run its business, and it's going to need to go find some external financing. So as we jump to the funds flow side, we've got to see where the financing came from. And so again, to map back to that idea that I don't have enough cash to pay my bills, and otherwise I'm going to go bankrupt, then I'm going to match the financing flows to that negative cash balance. So inflows into the firm are going to be negative numbers, right? To represent that that's the cash that I'm associated with my negative cash flow. So I need to bring in cash to the firm. So negative cash flows are inflows to the firm, right? So, but I still have to go through the same process. Cash from the income statement, cash in the balance sheet. Starting out with the income statement for my CFI. Anything labeled as a 3. Go back to my statement of TII. That was my after-tax interest expense. Right? Good news is that's already a payout. Next, balance sheet. TFI 3s. I have 2. Short-term debt, long-term debt. Now I could simplify this by just adding the 2 and call it change in debt, but in this case I'll just break it out individually. So I have a change in short-term debt, change in long-term debt. Right, so short-term debt went from 0 to 240. And long-term debt went from 760 to 920. All right, so let's think about this. If I am increasing my short-term debt by 240, that's bringing cash into the firm. Should that be a positive or a negative sign on this side of the statement? Should be a negative sign because I'm bringing cash into the firm, right, to finance that negative cash deficit. So I have to flip the sign here. So when I increase my short-term debt, it's a negative on this side of the statement. Same thing when I increase my long-term debt, it's a negative on this side of the statement. Right? Next, I have to do my equity. Right? So for equity, I'm looking for anything that's a 4. Now this is one of the tricks. On the income statement, I don't use net income because net income is not a cash flow. Right? That's why I included the dividends. That is the cash flow from the income that is going to the equity holders. That's just something we're just going to have to remember. That's our 4. That is the income statement impact of the 4 on the CFI statement. And then I look at the change in the balance sheet 4s. Right? So in this case, do I have any 4s in my balance sheet that change? Common stock is 1. So change in common stock. So the company issued shares. As common stock went up by 50. So that's bringing cash into the firm. So again, positive or negative number? Negative number. I got to flip the sign. All right. Next, I have a change in retained earnings. Change in retained earnings, I don't put on here, trick number 2, because retained earnings is a non-cash account. And so a change in a non-cash account does not affect CFI. Okay? So change in retained earnings, I don't want to put on there because then my statement will never balance. Finally, I have a change in treasury stock. Treasury stock occurs as a contra account when I buy back shares. All right, so the amount of shares that I've repurchased is a contra to the equity, just subtracts the equity on my balance sheet. So in this case, treasury stock went from -100 to -250, which basically means the contra count increased by -150. So therefore, I'm basically buying back more treasury shares. I bought back 150 worth of treasury stock. Is that a cash flow that's going to the shareholders, or is that coming from the shareholders? It's going to them. I'm buying their stock back, I'm giving them cash. So in this statement, positive or negative? Positive. Once I've done all my 3s and 4s, I can sum it up and hopefully get a balancing CFI. If I didn't, I made a mistake. Yes, question?
Can you explain again why changing or an increase in excess cash reduces CFI?
So if you were to take cash out of your wallet and you give it to the person next to you and you say, hold it for me, then the cash in your wallet is what you can pay your bills with. So therefore, if you basically give it to somebody else, you can't use it from the cash in your wallet to actually pay bills based on what's in your wallet. Same principle. So excess cash is money that's being put aside into essentially a savings account. And so therefore, it's cash that's not available to actually pay out to the investors. So marketable securities, exactly. So I'm going to put it in some relatively low risk investment. Now, if I've made it into an asset where I bought more plant, well, then that's operating. I would have invested in property, plant, equipment. That's CapEx. If I had put it into another company and I bought, shares of another company, then that's an equity investment. It wouldn't be excess cash. But if I literally just park the cash in the bank, then that is cash that's excess cash. And what we're saying, just to function the statement, is that's cash that cannot be paid out to investors. Now, eventually, the opposite works, which is if I draw out cash from my savings, draw down the excess cash, then that adds to the CFI that I'm paying out. So really, CFI becomes to some degree a plug for the company's cash. All right, but that's just the conceptual way to think about it. It'll help you with the statement as you go forward. All right. I'm sure many of you struggled with this statement and probably took a lot of time. You'll notice that from start to finish, we finished all of this in a little under 30 minutes. So basically, when you do your midterm, you're going to have an hour and 15 minutes. All right, so the more practice you get doing this, including homework 4, the better. But the midterm is in 2 weeks, 2 weeks from today. So the format of the midterm is going to be to walk in, I'm going to give you these statements, you got an hour and 15 minutes to convert them. And the difference between this and the midterm is there will be more categories in more years. So there'll be even more complex statements. But it doesn't matter because everything is already labeled for you at 1, 2, 3, or 4. So for example, on homework 4, you're going to have to deal with minority interest in the balance sheet, minority interest on the income statement. All right? It's a 4. You're also going to have to deal with preferred shares and preferred dividends. Those are also 4s. All right? And some other categories as well. So again, structurally, just look at it. Where is it on the income statement? If it's below taxes, it's probably an after-tax number. If it's above taxes, it's a pre-tax number. I got to tax affect it. If it's on the balance sheet, 3 or 4, put it in the debt or equity category. And the only tricky part is preferred dividends. Preferred dividends on the statement of TII are actually not going to be part of our statement of TII. Our TII will be income before dividends. Okay, so preferred dividends are like common dividends. We'll have to account for them in the CFI, but they're not going to be part of the TFI. Questions?
On the video that you posted, I think Vaughn asked a question about minority interest being a liability in some cases.
It's going to be listed as a 4.
No matter what class.
If you list as a 3 or list as a 4, you're going to get the same answer to the CFI, so it really won't matter. All right. Matter of fact, as I said, the accountants right now are reviewing minority interest to decide how they want to classify it. But for our purposes, we're going to consider it an equity stake. So it's the equity of another shareholder. But it's still a liability to those shareholders. So it's kind of like a bridge account between liabilities and equity. But in either case, it's going to be on the financing side of the business. When I have more minority interest, that means I'm basically taking money from those minority shareholders and putting it into my business. When I have less minority interest in the balance sheet, I'm paying cash out, so it's a positive number, and I'm paying back the shareholders. And then I have to take minority interest off the income statement. which I'll label as minority interest IS as opposed to BS. And that's the share of the earnings that go to those minority shareholders. So I had to account for that as well. Right? And that's going to be, think of it that way, as a cash flow to those equity holders, kind of like a dividend, is the way to think about that. Yes?
What's part 2 of the midterm?
Part 2 of the midterm is going to be, do you understand what you just converted? So that's actually what part 2 of homework 4 is going to be. So different than homework 3, on homework 4, there's a question that basically says, explain the CFI. So here's the CFI. If this were the homework 4 and if this were the midterm, then you're going to have to basically start to interpret this. All right, and that's what we're going to go through in just a few minutes. How do we explain the CFIs? Okay. All right, so one more quick statement. We had to do the economic profit and the ROIC. So I'll create a tab called EP. Change my zoom. Make it a little bit bigger so it's easier to see. So I need my NOPLATs, and I need my invested capitals to get my ROIC. And I'm going to ask you to calculate a beginning of year ROIC, which means I'm going to take my current year's NOPLAT divided by previous year's invested capital. Add 1 decimal place to that. 5.6 and 10.6%. Next, I'm going to have a cost of capital. On this homework assignment, it was 10%. On the next one, it's not going to be 10%. Pay attention to the assumptions. I believe it's 9% of the next assignment, but it does vary by assignment. So again, please check the cost of capitals. Don't just hard code those numbers in. That's going to give me a spread. ROIC minus WACC, which in this case is a negative number. Copy, paste, and then a slight positive number, 2012. And so my economic profit equals my spread times beginning of year invested capital. Method 2, I take my NOPLAT, I subtract off my capital charge. My NOPLAT is my NOPLAT. My capital charge equals the cost of capital, the WACC, times last year's invested capital. My economic profit, capital charge, WACC, times beginning of year invested capital, equals NOPLAT minus capital charge, and if I did everything right, it should balance. Okay. So basically, that's the solution that's posted. The only difference is the solution online does not include any of the formulas. You have to create your own formulas. I gave you the numbers. Okay. All right. So somebody asked about, well, how does this differ when we get to the midterm and the analysis of this? So here's just some questions I might ask. Given the data that's on the screen, for 2012, is the company creating value? Yes or no, and why? All right, the correct answer would be yes. How do we know it's creating value? Because it's got a positive economic profit, or what's another way of saying the same thing? It's got a positive spread. Right? Is that the case for 2011? No. Right? Is it possible to create value and have negative cash flow? Negative CFI. All Well, look at 2012. Are we creating value? Do we have positive CFI? Why do we have no cash flow in 2012? That's right. So what they did is this company, which had a positive operating profit in capital it started the year with, made a substantial investment in new investments. It put a lot of money into CapEx, and it bought another company. And those investments haven't paid off yet, but based on what it had, it's actually creating value. So the assumption an investor might make is, gee, that this company's trying to grow, and it's growing a business that currently has a positive spread. I might think that will eventually create cash flow in the future. Does that make sense? All right. So, again, why does the business have cash flow, free cash flow in 2011 that's positive? What's different about 2011 versus 2012? Just looking at the free cash flow. Well, it's getting 82.6 of free cash flow that's positive because the gross investment is less than the gross cash flow. They didn't spend as much on CapEx, and they didn't make an acquisition. And they saved money in working capital. So their gross investment was substantially lower. It was much lower than their gross cash flow, and their free cash flow was positive. Right? So what can we say about the reinvestment rate? What's the reinvestment rate in 2011 versus 2012? Which one's above 100%? 2012. Because they're taking every dollar profit they make and then they're putting it back in the business plus more. In 2011, this company doesn't have a 100% reinvestment rate. It actually has cash left over to equal a payout rate. Okay? So it can afford to pay money out based on operating activities. However, in 2011, can it actually pay out that free cash flow to investors? Does it generate enough cash to pay out to investors when all is said and done? Look at the non-operating cash flows in 2011. When the non-operating cash flows are added into 2011, does this company have enough cash to pay out to investors? No. Why not? Sorry, this is not supposed to be change in goodwill. That's supposed to be change in equity investments. Sorry, a little bit of mislabeling there. Because if you look at C13 minus B13, it's actually change in equity investments. Sorry, my little Freudian slip there on the on the typos. So that's the point. It made big equity investments in 2011. Right, so it didn't do an acquisition, but it bought stakes in other companies. Right, and that buying a stake in another company more than chewed up how much cash it generated from operating activities, causing the CFI to go negative. Right? So that's what I'm saying. Those are the types of things that we're going to have to be able to start to understand. What is the statement essentially telling us when we evaluate the company? Right. So I'm going to jump over here to lecture 6 and go through a couple key points of the lecture note this week. So we talked about EIC, and EIC is 1/4 of your group projects this semester. The second quarter of your group projects is the historical analysis of the companies. And there's going to be two parts of that historical analysis. One is analyzing the CFI, and the second is building out a 5-year historical ROIC tree. Okay? So first I'm going to talk about the CFI. So I'm going to use this company, AECOM, as a working example. So AECOM is a construction and engineering firm located in Los Angeles that's been a roll-up of high-end manufacturing construction firms around the world. So they're the company, if you have a very high-profile engineering thing that you need to have built, and there's a lot of risk with it, you call them. So for example, they just built the Barclays Center in Brooklyn. they're building the new tower for the World Trade Center replacement in Manhattan. All right, but they're global. So doing dams around the world, giant projects. They're the people that you call if you got a big project. Right? There's a few other companies, but they do a lot of the high-end engineering work. So what I want to do is I want to understand what's happening to this company's cash flows over the last 5 years. So what we're going to do is we're going to convert 5 historical years for our group project company. We're going to sum them up, just like we did last week with United Health Group, and we're going to tell the story. And as we tell the story, our structural story on CFI is going to have 4 parts to it. CFI is what's going on with the operating cash flows, what's going on with the non-operating cash flows, how do those two together create CFI. And then the third and fourth part of our story is, if positive, where'd the money go, the debt and the equity, steps 3 and 4. If negative, where'd the money come from, 3 and 4. All right? So structurally, that's what we're going to want to tell. Right? On homework 4, you're going to have to do that for both historical years. So you have to convert the statements and do both historical years. For your group project, you're going to have to do it on 5 years of much more complicated data. Okay? So again, I'm going to focus on the total to get us started. So here's what I know about their operating cash flows. Their free cash flow over a 5-year period was negative $1.6 billion. So right off the bat, think about what that tells us. Right? What does that tell us about their investment rate? It's more than 100%. Here's a company that's taking all of their profits and putting it back into growth, all right, to try and grow their business. Now, where are they putting that money? Are they putting that money to grow by investing in their own property, plant, equipment, or are they trying to grow through acquisition? It's acquisition, because they're spending a whole lot more on investment in goodwill than they are on capital expenditures. Matter of fact, if you throw out the investment in goodwill, then they're pretty much break even on free cash flow before goodwill, right? And then they spend another $1.6 billion on acquisition premiums, right? But they're spending a lot more on goodwill than CapEx, but basically they're putting about 100% of their cash flows. They're putting $1.355 billion of their profits back in their business in working capital and CapEx, and they're spending the rest on goodwill to get negative $1.6 billion and a negative 123% investment rate. So the reinvestment rate's 123%. When you answer these questions in this class, it's important to not just be vague, but to reference specific numbers. So I've instructed our TAs when they grade this, that if you don't name names, if you don't put numbers into your answer, to not give you credit. So you can't just say they had negative cash flow and that hurt them. You got to be specific with the numbers. Their cash flow was negative $1.6 billion over the previous 5 years. Okay? All right. Second, CFI. What's happening when I include the non-operating investments? Well, non-operating, they went from $1.6 billion of operating cash flow negative to negative $1.8 billion of CFI. That means they chewed up even more cash in non-operating investments. The biggest chewing up of cash was an increase in excess cash of $236 million. So back to the question that somebody asked earlier, they're taking cash and they're putting it into the savings account. Now what's interesting is, did they have the cash to put in the savings account? No, because they didn't have any free cash flow. So basically, how are they going to get that cash? They're going to have to borrow it. That's going to be somewhere in the 3s and the 4s. All right? So there's going to be 2 major areas for most companies that you're going to see that impact the non-operating cash flows. One is the change in what they're doing with their excess cash. 2 is just like the increase of equity investments. That's the increase in non-operating assets, proxy for equity investments. Are they buying stakes in other companies? For them, not too substantial. All right? So they had negative CFI over the last 5 years. Now, where did the cash come from? Well, if you look at it, the vast majority of the cash came from debt. $1 billion of new debt. That's that negative 1025. Right? So they borrowed a lot of debt. They also got $165 million by not funding their employee retirement accounts. Okay? Kind of owing money to the employees. and they issued $317 million worth of new stock. Right? So basically, when you talk about the 3s and 4s, it's what are they doing with interest? Did the company change its debt? What are they doing with dividends? Did the company buy back or issue new shares? Now, to get the statement to balance, we have this catch-all account called other adjustments to equity. Right? And that's where the accountants do crazy stuff to balance sheets. Right? Where they just arbitrarily move stuff around, foreign currency gains or losses of assets in other countries, things like that. Right? So the AOCI catch-alls are in that other adjustments to equity. So what we're going to primarily care about is what's happening to the debt and the equity holders. So that's what I said. Interest expense, change in the debt. Dividends, change in the actual shares issued or bought back. Right? So in this case, they are repurchasing some stock. They're kind of issuing about what they're repurchasing, but mostly they're funding their deficit through an increase in their debt. Right? Now, if we look at over the 5 years, one of the things that we notice is that CFI was a little bit more negative in 07 and 08 and then turned slightly positive in 09. Right? So one of the reasons that it did, and we can quickly see here, is they started slowing down their investments. They didn't make any more acquisitions in 09 versus 08, and they slowed down their CapEx in 09 versus 08. That would also be expected, because basically we're in the middle of a global recession, and this is a construction company. So it probably doesn't make sense to make huge investments in the middle of the recession, and you can see that as they focused on cash. But as the housing recovery seemed to start to take hold in 2010, notice that they went on a buying spree again. They started the acquisitions up in 2010, 2011, sending their free cash flow negative, sending their CFI back negative. Right? So those are some of the things that we want to do. We eventually want to talk about some of the specific years, some of the key items to get insight into what's changing. You'll practice that with homework 4. Now, eventually we'll do this at an industry level. So this chart has the converted CFIs of their major peers. I just pulled a couple of numbers out of the highlights. So, if you look at AECOM and some of their major publicly traded peers, look at that free cash flow number. Tell me what that tells you is going on in this industry over the last 5 years. They're investing in growth. So, we can probably infer from AECOM that it's probably acquisitions, that they're all probably doing some acquisitions. But we don't know without getting some of the detail. But we all know that they are trying to invest in growth because the reinvestment rate is more than 100%. And the reason I know the reinvestment rate is more than 100% is because the free cash flows are negative 29.51. They're spending and putting in $2.9 billion more cash than they're generating, than that gross cash flow. Okay? Now, notice though the change. When was most of this gross investment being spent at the industry level? It's really 07 and to some degree 08. And you'll notice that since 09, after we knew we were kind of in this global recession, that the spending on free cash flow, spending of that free cash flow slowed, and in a way, the free cash flow turned positive, particularly in 09 and 011. And you'll also notice they went from giving a little bit of money back to shareholders to a lot more money back to shareholders. Right? So this is what the analysts would start calling disciplined growth. So the analysts are keying on, look, you don't have great investment returns in this industry. So instead of buying back companies, why don't you buy back your stock? Right? So start giving us the cash rather than reinvesting it in a market that is far more uncertain. All right, so as you're seeing, they're slowing down the investment rate, creating free cash flow, which allows them to create a payout rate. Right? So you can start to see this in the industry. As their free cash flows went from very negative to positive, right, to almost break even, it created the ability to generate cash to start paying out. Right? Now, next thing we'll look at is industry ROIC. And one thing we'll notice is that industry ROIC peaked at 13% based on our ROIC calculations and has been falling. So think about this. If cost of capital is probably going to be somewhere around 10% for this industry, So if they're earning close to their cost of capital, then it probably doesn't make sense to make huge investments on growth, especially if the ROICs are starting to drop. So I start slowing down my investments. I don't really want to have huge negative free cash flows, and I start returning some of that cash back to my investors. And by the way, if they earn approximately their cost of capitals, then all of that excess growth that they're putting their cash into is not being valued by the market. So these have been pretty flat stock prices over the last 5 years. Right? Now, one of the questions we're going to deal with that the book talks about in the reading you did for this week is whether we look at ROIC, whether we look at CFI before or after goodwill. And the answer is we're going to look at both. Now, by definition, ROIC is always after goodwill. Free cash flow is always after goodwill. However, we will look at a before and after goodwill. Right? And the primary reason is we'll look at ROIC before goodwill to see the actual performance of the business if we take out our purchase premiums. Right? So, translation. Look at the average ROIC without goodwill for these companies. It's around 30% pretty consistently. So when we talk about organic growth, if a construction company wins the business to build a new multi-billion-dollar hydroelectric power plant in some country, then they're probably going to make a pretty good return in their investment. If I go acquire somebody else's hydroelectric project that they're building, then I only make close to 10%. Right? So if I just win the business and execute the business, I make 30%. When I buy somebody else's business, I end up making 10%. So really, the price that I'm paying for all this acquisition is just hurting my ROIC and turning a 30% ROIC into a 10% ROIC. Right? So it doesn't mean that I'm buying bad projects. I'm buying some very good projects that are probably making 30% because that's the average return on investment without the goodwill. What's the real challenge that this industry faces? It's how much they're paying for those acquisitions. They're paying a lot for those acquisitions, turning 30% ROICs into close to break-even cost of capitals. So what they're doing is they're taking all the premium for these projects and they're giving it to the historical investors. And they're saying, we'll take all the risk and basically come close to earning our cost of capital. And what I'm telling you is the market is looking at this and they're like, well, I'm not sure I like that strategy. Because you're taking all the upside and you're just paying it out in the acquisition. And then you basically work really hard to break even on a spread basis. Right? So you're not really generating a lot of extra cash flow that you're paying to me because all that cash flow is going to the historical investors that actually own the projects before we bought them. All right. Second part of our historical analysis will be the ROIC trees. I'm not going to go over what they talked in the book because I assumed you've read it. But we're going to create these historical 5-year ROIC trees. And so here's an example of a 5-year tree for AECOM. And the trees are going to be based on EOY ROIC, which stands for end of year. Okay, so as opposed to the beginning of the year that we're going to do in our models, we're also going to create an end of year ROIC in the tree. So based on spending the money that you spent this year, so December 31st, this year's invested capital versus last year's. So here is the last historical 5 years of the company's ROIC. And so what we're going to have to do is based on the historical analysis, we're going to have to talk about the 5-year change in ROIC. Why did the ROIC 5 years ago at 10.4% go down to 8.4% 5 years later? Okay. There are 3 reasons, always 3 reasons, for the answer to this question. And you will have to always explain those 3 reasons as part of your midterm and your group project and your final exam. Reason number 1, tax rate, or we'll call the cash tax rate. In 2007, this company paid 28.8% in taxes. In 2011, this company paid 26.1% in taxes. Is that tax rate helping or hurting their ROIC 5 years later? I went from paying 29% in taxes to 26% in taxes. Is that helping or hurting my ROIC? Should be helping. So taxes are not the reason that the ROIC is going down. Matter of fact, all things being equal, the ROIC should go up because we're paying less taxes, right? So our ROIC is not going down because we're paying more in taxes. Matter of fact, taxes should have helped our ROIC. So we can clearly see that with the pre-tax ROIC. We strip out the impact of taxes, we can see that the ROIC went down even more pre-tax, which is really the performance of the business, 14.6 to 11.4. So, drivers 2 and 3. What drives pre-tax ROIC? Margin, productivity. This times this is that. So these two, well actually this times 1 over this equals that, but these two have equal weight in determining your ROIC. So, what do I know? In 2007, the pre-tax operating margin of this company was 3.4 cents in the dollar. In 2011, the pre-tax margin, EBIT divided by sales, 4.7 cents. Should that help or hurt my ROIC? That should help. I'm making more operating profit per dollar of revenue. That should help my ROIC. So, in terms of why is ROIC falling for this company, it's not the margins, and it's not the tax rate, so it must be driver number 3. Driver number 3 is the productivity. This is the cycle time variable. It's invested capital per dollar of sales. So a higher invested capital per dollar of sales means I'm spending more money to generate more sales. That's less productive. In 2007, to generate $1 of revenue, they invested 23 cents. In 2011, to generate the same dollar of revenue, they invested 41 cents. So they're spending a lot more to generate the same sales. That was the primary reason for the ROIC decline. Everybody see that? So that's the first level of analysis we're going to have to do on the historical ROIC trees. We're going to look at historically where they were, where they are today, and how did those 3 variables work to explain the change in the ROIC. Then we're going to do what we call the second level of analysis. We're going to drill down on the operating margin, and we're going to drill down on the productivity. So I know that the operating margin improved, EBIT divided by sales, operating income divided by sales. So what are the drivers of operating margin? Gross margin from the income statement minus SG&A minus depreciation equals operating margin. So this minus this equals that. Those are the 3 drivers. Right? What can I see? Gross margin went from 5.7 to 7.2. That helped their operating margin. SG&A 1.3 to 1.1. That helped it slightly. Didn't really change it all that much. Depreciation 1.1 to 1.4. A little bit more in depreciation. The primary reason the operating margin went up is therefore what? It's the gross margin. Gross margin is the difference between price and cost of goods sold. So they're getting better price on their cost, or they're reducing cost for their price. But they're getting essentially better markup on their manufacturing costs, the cost of actually making these buildings that they're building. Okay, so that's better for them. All right. Second level of analysis on the productivity. Working capital plus PP&E plus intangibles equals invested capital to sales. Right? These are the 3 buckets of invested capital to sales. Add these 3 things up, you get that number. Okay? So we know they're spending a lot more in invested capital to sales. Level 2 analysis. Are they spending on working capital? Well, working capital went from 6.5 to 11.2. They're spending a lot more on working capital. Next, PP&E went from 2.8 to 4. They're spending more on property, plant, and equipment. Intangibles, goodwill and intangibles, went from 14 cents to 26 cents, up by 12 cents. Right? So all 3 things, working capital, PP&E, spending and acquisitions, went up as a percentage of sales. Which one had the biggest impact? It was the acquisitions. That they were spending 14 cents per dollar on acquisitions in 2007, they spent 26 cents per dollar on acquisition premiums by 2011. So if you really want to look at, this went up by about 19 cents. 12 of the 19 cents was acquisitions. 5 cents was working capital, and the balance in PP&E. About 2 in PP&E. Okay? So basically, if I really want to think about this, it's all that money they spent buying other companies hasn't paid off yet. Right? And they bought it into a market where we've seen declining ROICs, and we bought into a market where all those premiums were very high. We took 30% projects and made them 10% projects. Right? So again, if I really want to think about why did the company's ROIC fall, despite the improved margins, despite the better tax rate, it was the loss of productivity. It was all that investment they made that didn't translate into more sales. And that more than offset the hard-won gains they made in their profitability. So that's what we'll call the second level of analysis. Does this make sense? Questions?
Yeah, here the PP&E.
Yep.
Was the problem?
No, here PP&E went from 2.8 cents per dollar to 4 cents per dollar. It got a little worse, but I'm just saying it went up by 1.2 cents. The real amount that went up was the intangibles going from 14 to 26. That was, in terms of per dollar of sales, that had the biggest negative drag on productivity. But also working capital, which is, if you take the intangibles to sales out, you can see how they did without goodwill. Then the point is that working capital is something they control. All right, I, as a manager, don't control how much somebody bought my company for. I, as a manager, control my efficiency of working capital. So it's all about, hey, we have too much inventory. How do we have less inventory than we did before? Hey, we take too long to collect our bills from our customers. How do we increase our payments? Okay. All right. So once we have done the individual company analysis, then we're going to do this at the industry level. So we'll then convert our peers, and then we'll do an industry ROIC on our peers. So here's the industry tree. Okay. So that's more of a preview for where we're going on the next level of analysis. That's not part of homework 4. But as I said, on the midterm, these are going to be some of the questions you're going to be asked, is to interpret these trends and to tell me whether these trends are favorable or unfavorable and why over time. Okay. So that's what somebody kept asking, what's part 2 of the midterm going to look like? That's part 2. Because right after that, that's what we're going to do with real companies. And that's where the group project work is going to start, is that we're going to build all these models that take real data, put them into this format, and start interpreting. Right now, we're still dealing with the hypothetical simple company for homeworks 3 and 4. All right, but that's why I said practice there, because if you understand with the simple statements what's going on, then when we get to more complex statements, it will make more sense. But what we just did in Lecture 6 is the next quarter of your group project. So you have to do the 5-year historical CFI and the explanation. You'll have to do the 5-year historical ROIC and the explanation for your company. All right. What you need to do on homework 4, though, is convert the 2 years of CFI and just simply talk about the changes in the CFI. So specifically, what's going on with the operating cash flows, free cash flow, positive or negative, why, how is it changing? What's going on with the non-operating cash flows that are causing CFI to be positive or negative from the free cash flow? And then debt and equity. Again, assuming positive CFI, where'd the cash go? Assuming negative CFI, where'd the cash come from? And again, be specific with the numbers when you do your conversions. All right? So again, no class on Wednesday. I'm giving you class time to work on this next conversion assignment. The TAs have office hours. Rafi's there right now, is just visiting between classes. He'll be there again on Wednesday. Lisa's there on Thursday. She'll be in the Bloomberg lab tomorrow. Use the TAs to help you with this. Use the class time on Wednesday to convert this. This assignment is due 1 week from today at 10 a.m.